by first evaluating the proposal. So the net sales we've been given is 1 lakh rupees, which is the increase basically. So we will also see what will be the cost. So we will have to reduce 80% as cost of production and selling expenses, because it is mentioned in the question that production and selling expenses amount to 80% of sales. That comes to 80,000. So profit now, as of now, before considering anything else, is 20,000. Now we have to reduce bad debts to the tune of 10%. So that will come to 10,000 because 10% is on the sales. Now profit before tax now will be 10,000. Then again we will reduce the tax at the rate of 50%, which is 5,000 of 10,000. So profit after tax will be 5,000. Now we have to understand what is the opportunity cost of investment in receivables. Now how do we calculate it? We know that the total cost is 80,000, which is stuck. Now we know that the collection period is 1.5 months. So we calculate the opportunity cost of investing that money elsewhere. And we also know that the rate of return given is 25%. So how do we calculate? We calculate by multiplying the total cost by the rate of return for the collection period. So it will be 80,000 into 1.5 divided by 12 into 25%, which comes to 2,500. So the net benefit that we get is 2,500 after reducing the opportunity cost as well. So now we know that the sales manager should be advised to take the proposal because the net benefit is in the positive. The next question is on the acceptable degree of risk of non-payment. So the three scenarios given is when the required rate of return is 30%, 40% and 60%. Sales we know will remain the same, that is 1 lakh. The production and sales expenses as we calculated earlier is also 80,000, which will remain the same. So the profit will be 20,000. Less bad debts. This is the figure that we have to derive because they are wanting us to understand what is the degree of risk of non-payment that the company would be ready to take in all these three scenarios. So we assume that as X. So the profit before tax will be 20,000 minus X in the first column, in the second one and the third one as well. Now we will reduce the tax at the rate of 50%. Now profit after tax after this calculation will be 10,000 minus 0.5x in each of the cases. Now what is the required rate of return given? It is 30% of 10,000. Now how did we get 10,000? We have to calculate the average debtors now. So total cost of credit sales we know is 80,000 into collection period is 1.5 months. So when we calculate the average debtor, it will be 80,000 into 1.5 divided by 12 months, which is 10,000. So all the rate of return we will apply on this cost. So in the first case it will be 3,000, second case it will be 4,000 and third case it will be 6,000. So profit after tax will be equal to 3,000. So if only in that case we will be able to find out what is X in each of these cases. By doing that we will find out in case 1 the X is 14%, in case 2 it is 12% and in case 3 it comes to 8%. So we understand that the acceptable degree of non-payment is 14, 12 and 8% if the required rate of return after tax is 30%, 40% and 60% respectively.